All right, let's dive right into this. I want you to think about your weekly routine for a second. You grab your keys, maybe hop in the car, or just walk down the street to pick up your groceries, grab a prescription, or maybe snag some household essentials. You walk through those sliding automatic doors without a second thought. But I want to ask you a question that honestly most of us never pause to consider. Who actually owns the physical buildings you're stepping into? Who owns the land underneath those sprawling parking lots and those massive store aisles? Well, the answer to that question reveals an entire, basically unseen layer of our economy. Take a bustling real Canadian superstore, for example. You see the cars, the people, the massive storefront, right? It's just a place to buy your milk and bread. But if you look at it through the lens of commercial real estate, this isn't just a grocery store. It is a highly strategic, incredibly valuable, income-producing asset. It's literally a key node in a multi-billion-dollar network that quietly structures the daily lives of millions of people. So, welcome to our explainer on choice properties. Today, we're decoding the immense scale, the financial mechanics, and the strategic foresight of Canada's largest real estate investment trust, or REIT. We're going to make the invisible visible and show you exactly how this purpose-driven real estate platform operates at the absolute center of Canadian commerce. Here is our roadmap for today. 1. Canada's real estate giant. 2. Q 2026 financial highlights. 3. The power of necessity retail. 4. Building for the future. And 5. Sustainability and community impact. Okay, Section 1. Canada's real estate giant. When we call choice properties a giant, we aren't just using colorful language here. The macroeconomic footprint of this REIT is absolutely staggering. Choice properties own 699 high-quality properties across the country. That is nearly 700 individual massive pieces of real estate, strategically positioned in local markets right where Canadians live and work. In those 699 properties, they represent 68.6 million square feet of gross leasable area. To put that crazy number into perspective, that is roughly the equivalent of 1,200 American football fields of commercial and industrial space. And it's all spread across 3 strategic asset classes: retail, industrial, and mixed-use residential. So what is all that land and concrete actually worth? Try a jaw-dropping $18.1 billion in fair value. No joke. This makes them one of Canada's largest urban landowners. They don't just participate in the real estate market. They are quite literally a foundational pillar of it.
Moving right along to Section 2, Q2 2026 financial highlights.
Now, having a massive portfolio is one thing, but how is this real estate giant actually performing in the current economic climate? Well, even in a pretty complex retail market, their resilience really stands out. Let's look at their same asset net operating income. Basically, that's just the profit generated from properties they already owned. In Q2 of 2025, they generated $248.5 million. Fast forward to Q2 2026, and that number has grown to $255.4 million. That's a 2.8% increase year over year. And honestly, here is the real kicker. Their overall portfolio occupancy is sitting at an incredible 97.7%. Their buildings are essentially completely full, generating stable, predictable, and growing cash flows. But look, growth doesn't mean much if your financial foundation is crumbling, right? That's where this next metric comes in: 7.0 times adjusted debt to EBITDA FA. In plain English, this just means they carry a very healthy, very manageable level of debt compared to the cash they generate. Plus, they hold over $14 billion in unencumbered assets, meaning properties totally free of mortgages. And they maintain investment-grade credit ratings from DBRS and S&P. It is a fortress balance sheet, totally designed to weather economic storms. And you know, this confidence is echoed right from the very top. Rael Diamond, the president and CEO, highlighted these exact points, pointing out their robust leasing spreads, which just means they're successfully charging higher rents on new leases, along with that same asset growth we just talked about. It's one thing to look at the spreadsheets, but it's another to see how strategic management actively translates into these really confident quarterly results. All right, Section 3, the power of necessity retail. So how exactly are they pulling this off? What makes their revenue so incredibly unshakable? The answer lies in their core operating philosophy, a relentless, laser-focused strategy on necessity. Out of that massive 68.6 million square foot footprint, the weight distribution is extremely deliberate. An overwhelming 44.6 million square feet is purely retail. Industrial makes up 22.2 million, and mixed use and residential sits at 1.8 million. Retail is the absolute undeniable bedrock of their cash flow. But we aren't just talking about any retail here. The secret to this stability is right here in the numbers. 83% of their retail portfolio is necessity-based. We're talking about grocery stores and pharmacies. More than that, 64% of their retail revenue comes directly from Loblaw banners. Because of this strategic partnership with Canada's largest retailer, their tenants are highly reliable blue-chip companies holding long-term leases. We're talking a weighted average term of 5.8 years. Think about it. Whether the economy is booming or busting, people absolutely still need to buy food and medicine. By building a portfolio around those daily necessities, Choice Properties effectively insulates itself from typical retail volatility. I mean, just look at Shoppers Drug Mart and Dollarama. This is exactly what necessity-based retail looks like in the real world. These aren't high-end luxury boutiques that dry up during a recession. These are the essential pillars of local communities. When a property is anchored by tenants like these, the cash flow becomes exceptionally reliable. Which brings us to Section 4, Building for the Future. So we've established that their current operations are basically a fortress of stability. But how are they securing future growth? Just contrast their current operations with their future plans for a second. We just saw how retail completely dominates their existing square footage, but look at their 18.6 million square foot development pipeline. The retail total in there is just 0.5 million. Industrial is a very healthy 4.5 million, but a massive 13.6 million square feet of future development is concentrated in mixed use and residential, mostly in the in-planning and zoned and ready stages. They are taking their existing urban land and leveraging it to build transit-oriented multi-use communities. It adds this huge new growth engine right alongside their retail anchor. Now, that doesn't mean they're abandoning retail. Not at all. They're absolutely still strategically expanding their retail footprint where it makes sense. Take this brand new 123,000 square foot retail development in Nepean, Ontario. Nepean is one of Ottawa's fastest growing communities right now. By anchoring this new site with a no-frills and a Shoppers Drug Mart, Choice Properties is anticipating population growth and building those essential services right into the heart of expanding residential neighborhoods. They're literally laying the commercial groundwork for new communities. Finally, Section 5, Sustainability and Community Impact. When you manage nearly 70 million square feet of real estate, that comes with an immense amount of responsibility. And they aren't just talking about sustainability, they are actively building it. This is their Coventry Hills property in Calgary. It recently achieved a massive milestone, becoming the first retail project in Canada to earn the Canada Green Building Council's Zero Carbon Building Design certification. They incorporated an enhanced building envelope, fully electrified systems, and rooftop solar to reduce embodied emissions, which is basically the carbon footprint of the actual building materials themselves, by roughly 25% compared to a typical build. They're proving that low-carbon retail isn't just a pipe dream, it's practically achievable today. And this environmental focus ties directly into their broader ESG strategy. They've even had their net zero by 2050 targets validated through the Science Based Targets initiative. But their impact goes way beyond just carbon. Through placemaking initiatives like Lots of Play, they literally take their massive parking lots, like one in Toronto's Leslieville, and transform them into vibrant, free community spaces with live performances and workshops. It's super cool. And internally, their governance is leading the industry, with over 50% of their executives at the vice president level or higher being women, marking their third consecutive year in the Globe and Mail's Women Lead Here benchmark. Which brings us right back to where we started. Choice Properties isn't just a landlord. They are a fundamental architect of the Canadian retail landscape. They leverage this fortress balance sheet and a massive necessity-based portfolio to generate unshakable stability, all while building mixed-use communities for the future and setting totally new standards for sustainability. So the next time you park your car and walk through those automatic doors to grab your groceries, take a look around. Ask yourself who actually built the space that makes this all possible. Because once you see the invisible mechanics of everyday life, your local neighborhood will never look the same.